Oh, thank you for watching this video. This is part 6 of our inventory, QuickBooks inventory video. Uh, so in this video, I'm going to discuss how to handle inventory returns in QuickBooks. So I will discuss customer return as well as return back to vendor. All right, so I'm going to go to QuickBooks Online. Okay, so I'm on QuickBooks Online, and uh, the customer is sold 10 units in this case, and the customer wanted to return 1 unit. uh, Regardless, it's just wanted to return and get the credit. So in that case, if you have issued invoice and the customer hasn't paid yet, you just issue the credit memo. So it's basically the credit memo. It goes to customer, and then you select the same inventory item. So to go to credit memo is you just go from plus, and then you select credit memo. Okay, and then you want to return that back to your supplier. Assuming in this case supplier will accept your return and maybe send you another one. Okay, so in that case, just issue the vendor credit, and you haven't paid that invoice yet. So basically, this just create a vendor credit, and just use the reversal of the credit memo. So now, in this example, your original stock is 600, and you sold 10 units, and the customer wanted to return 1 unit, and you send it back to your supplier for that 1 unit. So in this case, basically, the inventory level is still 590 because it started with 600 and sold 10, and the credit memo for the customer as well as vendor, it's plus and minus, so it's a wash. So your stock in hand is still 590. Okay, basically, you're creating a credit memo to your vendor, and as well as the credit memo to your customer. It's just a transferring in and out type. Okay, so that's one scenario. And what happens if the customer wants to return it, and the vendor don't want to take this? Don't you can't return it to a vendor. So that's case, it's a loss. Whatever they return it, the customer return it to you, this is done. It's a loss on your side. You have to eat it. So in that case, let's just delete this vendor credit. So to delete your vendor credit. Okay. So now basically, you have inventory of 591. In fact, you only have 590. So for that 1 unit, you have to adjust your inventory, right, to make it correct. And before I do that, in this case, there's invoice as a credit memo. What if the customer already paid and there's no invoice balance, open invoice left? You can create credit memo. You can create a credit memo, but let's say the customer wants the money back. So in that case, instead of credit memo, you just issue the refund receipt. Just create a refund receipt for your customer, and select your customer, and then select a payment method, whatever, the by check or bank or whatever. Then select your bank account like this, and your inventory item like this one. It's the same 1 unit. It works the same way, except instead of creating your AR accounts receivable, it will basically credit to your bank account. So this is the scenario if there's no AR open and the customer wants money back. Okay, I'm not going to save that one. So it's basically now you're off by 1 unit, and you need to adjust your inventory because your supplier not going to take that your that part back. So then you have to make that this 1 unit go away, and all you have to do is just go to new and select the quantity on hand, quantity adjustment, and then select your inventory item. Okay, so now it's showing 590, and now you want to reduce it, make it to 590. So that's -1, right? -1. Oh, okay, so now it's back to 590. This is the inventory have. So in this case, it's basically uh, you can't put it back to your inventory self. You can't resell it. It's a garbage now. So you have to write it up. If you can resell it, normally when customer returns, you want to make sure it's the same product. You can resell it to your customer. So let's say you can't resell this now. So then you make your inventory adjustment, and if you can just keep it and resell it, then you don't need this one. Okay, and then you have to select the inventory adjustment. It's not a shrinkage. It's basically uh, adjust your cost of goods sold account. So shrinkage is the default is shrinkage, inventory shrinkage. It's like end of the year or when you took the physical, you have one item less and you don't know what happened. So in that case, you can use inventory shrinkage or just ignore that and just use the cost of goods sold. I prefer the cost of goods sold. This is where it went when you sold it. So just stay with the same account. So so this is what you have to do. Just I'm gonna save this and close. Now we're back to 590 again. So that's your stock on hand. So this is how you have to do it. So if you have a credit memo and your supplier is not taking that one back, then you do inventory quantity adjustment. And if your supplier wants to take it back, then you use your vendor credit from here, right here. So that's about it. So look for another video. We'll talk about something else on inventory. So this one is uh, part six. Uh, Part six of our video. So thanks for watching this video, and be sure to subscribe to our YouTube channel. We've been around for a long time, more than 10 years now, dealing with QuickBooks online, QuickBooks. So thank you for watching again. Bye.